A very good morning to you, everybody. Welcome to the Flow Show. Friday, nearly the weekend. Woohoo! Can't wait. Been a quick week since I've come back from holiday. It's gone very quickly, and yeah, can't wait for the weekend. Lots to do. Right, let's get stuck into things. And just to forewarn you, there's a Ryan rant coming a little bit later. And I know you guys and girls like to hear me ranting about stuff, so there's one on the way. Don't worry about that. Right, let's get straight into some of the data that's been going on, starting in China. Latest CPI numbers beating expectations to the upside. CPI year on year coming in at 0.5%, higher than the 0.3% expected and 0.2% prior. Oh, Gav, can you guess the subject matter? Oh, I don't know. You have a guess, mate. So things are picking up still. There's still pretty weak numbers, 0.5%. If we take a look at it, you can see we're not seeing any sort of mildly inflationary pressures coming in here, which will keep the PBOC on the easing side of things for now. We know they've been tinkering around with their rates and whatnot. They're still not throwing the kitchen sink at it, but it is possible still that we might get some further rate cuts and easing and whatever going on there. But as you can see, not out the woods there on CPI. Coming over to Europe, just again, not a lot of data out at all. A few CPI numbers, dropping final numbers mainly. Germany confirming their CPI numbers 2.3, 2.6 year on year for there, so no change there, although it does confirm the uptick over last month. Some CPI data from Norway as well, coming in year on year largely as expected, 2.8%, a little softer on the month. Again, another country just seeing inflation ticking up, that bumpy road that everyone keeps talking about regarding inflation. Over in Italy, CPI coming in much higher. Now, these guys are rocking well under, or were rocking well under 2%, if you like, which is the benchmark, shall we say, for all of Europe. So a jump up there. As expected, Italy's CPI jumping to 1.3 from 0.8%. The Eurozone measure coming at 1.6. A miss in expectations, but again, another gain over last month. Quite chunky gain over last month as well. And good old Greece in the mix there too as well, showing hotter inflation as well. So it's not a foregone conclusion about when we get the next rate cut from the ECB, despite what the market may expect given thoughts of what's going on with the Fed and whatnot. So that bumpy road set to continue for the Eurozone. There were some numbers out that are they on these calendars? Nope. Well, we've got some Q2 numbers from France. Unemployment rate showing a bit better, 7.3%. More importantly, wages, quarterly wages for Q2 came in at 0.6% versus a prior 1.3%. So that is good news for the ECB, particularly the likes of ECB's Lane, who's among others are making wages a big focus on wages, a big focus of monetary policy, and what wages do will help guide their stuff as well. Whoever that is, Zoom user, can you discuss stop losses versus trailing stop losses? Yeah, I can do that. Most certainly. We'll have a chat about that in a while. Coming over to data yesterday from the US, and another big lull moment for the jobs market. Everyone getting antsy after the NFP. We saw ISM services employment going into expansion from contraction after everyone was wetting their knickers over the softer NFP. Well, everyone was starting to wet their knickers over whether jobless claims were going to be flagging something bad, and they didn't. It dropped back lower than expected and lower than the revision last month as well. So, well, that was a worse revision, sorry, 250k. So 233s puts us back right in the box. Jobless claims ticked up a little bit, but we're still at 1.8 million. The 4-week average, though, did tick up, just reflecting the recent rise into the 240s again. And there's a lot of people who are now starting to jump on any jobs number they can, making excuses and whatnot. As you can see, we are in a bit of a trend higher, particularly for this year. But you look at the more longer term numbers, I mean, it's hard to gauge it there with that big spike. You know, we're still bumping along, you know, last 2 years or so, bumping along the 200s. There is nothing to worry about thus far in these jobs numbers, no matter what people pick through them. So always take a look at the wider picture. I say this about prices on charts to do with trading. I say this on economic data. It's all about trends, not week to week to week to week, although obviously we do get some moves on data points each time. Other data that we got yesterday, again, not big data, wholesale numbers, inventories. This was a final revision, so it stayed steady at 0.2%. Sales, though, a little bit softer, coming in at minus 0.6% and a downward revision to last month's positive number as well. So this is an area you want to keep an eye on the sales. Inventories are important because if you start seeing negative inventories, wholesales, retails, whatever, it is an indicator that activity might be dropping, because what people are doing is they're using up stock rather than ordering new stock. So if you've got 10 in stock and you sell 10, then you buy 10 and put 10 in stock again. Or what you do is if you've got 10 in stock, you only sell 5 regularly, you know you've got 5 in stock. If you start drawing that stock down and not ordering 10 again, it creates a drop in activity that passes all the way down the line. So inventories are important for monitoring activity. Start seeing some negative numbers, it's going to impact GDP in the months ahead. But then again, sales, that's also an important factor, because if you're not selling stuff, you ain't making money. If you ain't making money, there's going to be a problem. So again, it's a monthly number. We're seeing, you know, it's a bit up and down, so no real trends. But if you look at these numbers, we're getting more softer numbers than we are getting bigger numbers. Okay, so just something to keep an eye on when looking at economic numbers. Right, morning, Paul. JP Morgan, and this is going to, Gavin, yes, I'm going to get onto that one, but that's not my rant. So JP Morgan has raised the odds of a US recession by year end to 35% from 25%. Now, that's not a huge expectation, you know, less than a, you know, called a third chance that we're going to get recession. But if you're following news-wise, Twitter and whatever, you'll probably be noticing a lot of recession talk. Okay, it's like a golden egg to economists. Everyone seems to be chasing a US recession. They almost want a US recession because people are making it out like it's going to be important. First and foremost, it's not going to be important. Okay, so I'll tell you why it's not going to be important. Obviously, there's a caveat to that. We've seen recessions before. We saw recessions, technical recessions in other countries, Europe, UK, whatever. It doesn't mean the world is ending. Just because a country has a recession, a technical recession, it's not the end of the world. Okay, if you look at global growth numbers, and I looked at some of those this morning, there's very few countries above 1%. There's only about 7, 8, 9 countries in the whole world who have GDP above 1%. Everyone else is knocking around the 0 point this, 0 point that. You've seen it in Germany, you've seen it in the UK, you've seen it in the Eurozone. Okay, so when you get a recession in those circumstances, it's really not a big deal. It's all technical. Okay, the world won't end if the US goes into recession. Now, there's a difference between going into recession and seeing a big economic contraction where growth is minus 1%, not minus 0.1%. And that's the difference. That's the difference between, you know, soft landing and hard landing. If a US recession was going to be a huge contraction, okay, in growth, that's a problem. Just dipping into a minor technical recession isn't. So don't get sucked up into all these recession people shouting and screaming. trying to catch a US recession and making it into a bigger thing than it isn't. Because what will happen is the market will piss its pants. And to quote, that JP Morgan story was pumped by Reuters, and in the fluff of the story, they said fears of a US recession following weaker than expected July jobs report and an unwinding of yen-funded carry trades sparked a sharp sell-off in global equities earlier this week. Okay, fears of a US recession. Okay, this is the press trying to make it into a big deal, and you're getting others doing so as well. So we're going to be in one of these situations where you're trading markets and the market starts trading fear, and you have to decide as a trader whether the market moves too far out of whack, like it did this week. Okay. So we saw the market getting all panicky after last week's FOMC, after the ISM, after the NFP, and then boom, 2 data points later, everything's going the other way. People calling for emergency intermeeting cuts by the Fed. Bonkers. It's all bonkers. But this sort of shit moves markets. And what you have to determine as a trader is whether that bullshit is real or not. Okay. At the moment, if you look at stuff, we're seeing recoveries in things like stocks and whatnot. The market has seen through the bullshit. Okay. But this is going to continue. And more so, it's going to get bigger because we're in an election year. And if the one thing that, if there's one word that politicians hate, it's recessions. So it's going to be magnified purely on that basis. So to cut a long story short, you can listen to all these recession calls as much as you like. All you need to know is what does a recession actually mean? And then you can learn how to trade against that if the market gets too extreme over recession calls. And that's my rant. Okay, but well, half finished on the rant. The other rant is that clown Jeremy Siegel, who was calling for those emergency Fed cuts, has gone back on that call. He says there's no need for the Fed to make emergency cuts now, although he does say still that the Fed need to cut by big chunks when they do start cutting. So this is a guy who's in charge of whatever it is, Walton, funds managers or whatever they are. He's supposed to be a smart cookie, and he's coming out with bullshit like that. And at times the market listens. He's an academic, that's right. So the market listens to shit like that because they think these people are clever. These people talking out their asses. Okay, you should know what's going on. Right. Anyway, back to yeah. Of course, he panicked. Yeah, I don't. But why? You got to ask the question, Michael. Why did he panic? I mean, it's irresponsible. But I'm going to stop there. Otherwise, I will start really getting into it. But as I say, you've got to look for the trading opportunities amongst that. Sometimes the volatility is too much. You don't want to trade it. Sometimes it's just right, and you think, yeah, I'm fading that shit, no matter what happens. Anyway, moving on. We did have a 30-year bond sale, which following the 10-year sale yesterday, or sorry, Wednesday, which was very, very soft, came in better. Than no real worries about it too much. Again, we're in that situation where the market's a little bit nervous. So it's maybe taking a bit of a pickier attitude to picking up US debt, but it wasn't that bad a sale, the 30 years, certainly compared to the 10-year previously to that. We have had a Fed head out, Fed's barking, echoing what we heard from, who was it we heard from yesterday, talking about jobs, or the day before, someone else was talking about jobs. Anyway, Barkin said that what he hears from folks on the ground in the labour market is people are cutting back on hiring, but not firing. Was it Daly the other day who said similar? Anyway, he said no hiring, no firing. That's what we see in the data. And from here, it could go either way. It would be worrying, or what would be worrying, is if jobs growth started to disappear. So that's when you start getting negative numbers. Okay, that's a completely different scenario to just getting lesser jobs. Okay, it's a difference between soft and hard landing. He says wages are coming down, suggesting normalising in the labour market. He says, for me, the case for lowering in July would have either been absolute conviction that the labour market was on the precipice, or if you thought you had inflation under control. So that's his reason for not calling for a July cut, and obviously now we've passed that, all eyes are going to be on whether the conditions are there for September. A bank that did cut was F.A.C.E. They cut rates by 25 pips to 10.75. It was largely expected that they were going to cut rates, but it was a pretty close run thing amongst the economists. It was a close run thing amongst the F.A.C.E. bods too, because the vote was 3-2 for that cut in rates. So pretty close one. I mean, there's only 5 members, so it's always going to be a close one. For the future, the statement acknowledged that CPI, headline CPI, was still pretty elevated, although they expect it to dissipate over the coming months. But more importantly, their focus is on the core, and that the core has continued its trajectory lower and is set to do so. So that keeps cuts on the table, but they're not really in any sort of rush to start, cutting meeting after meeting. They said, looking ahead, the board foresees that the inflationary environment may allow for discussing reference rate adjustments. So cuts are still on the table, but there's no guidance to say we're going to be cutting again unless the data really performs to their expectations. So what we did see in the MEX, I don't know, we saw the MEX gain after the rate cut, and given it was a close run thing, you might have expected the MEX to weaken on the back of that. But we saw a gain. We'd already knocked under this 1920 area that I've been talking about. And this probably 1910, 1920s is probably a resistance area now if we do see any bounces. So we were already moving there before the meeting. And we continued it a little bit after the meeting, and have continued it today. I would say that's more a case of seeing some general dollar weakness. We're obviously seeing cable up, euro dollar up. So we're seeing some dollar weakness around the grounds, but also we're seeing some further weakness in the yen. So if you take a good old butcher's at our carry indicator, MEX yen, you can see that that weakening there is probably having more an influence on dollar MEX than what the F.A.C.E. is doing. So again, we're being driven by other forces at the moment rather than the meeting itself. However, we've got some levels coming up. We've got this fib. Let's just zoom out a little bit, just so you can see it. So we've got this fib off the lows. We've got 38.2 coming in 1871. So it's a bit of a level all on its own. So give it a bit of consideration. I'm not overly keen on it because, this move has been filled with spikes and volatile moments and whatnot. So I'm not overly keen on this fib when the market's as volatile as it can be at the moment. I prefer to stick to my bigger, longer term levels, as you know, the old 1850. We'll probably see some into 18 and then the 1740. So if you want to keep it simple, then watch for resistance up here, as I say, into 19s, 1920. Watch the 1850. Any move sub that down to the 60s, 1740s down there for that. Right, just some other bits and bobs. Over in Russia, it seems like we've got a bit of a pickup in activity there. It seems like Ukraine is mounting various offences in different areas, stepping up their push sometimes into Russia as well, even if convoys being taken out in Russia. So it has been a bit of a step up in that. It's always bubbling under the surface, but when Ukraine tends to have a big moment, it's usually followed by a big moment counter-attack of some sort from Russia. So if this is stepping up in action, shall we say, then just keep an eye on risk trades as well, because the bigger things happen, the more the market's going to take notice of that. Mr. Trump has said that it's the president's right to have an influence on Fed policy. So there's further talk that he might start interfering in what the Fed does should he come in. he's been that way all the time. We know he likes to throw out these sort of comments, but again, just file it in your back of your mind, in your election notes as to what might happen. These sort of headlines can have an influence on markets. A bit of news for the UK as well. The FT put up a piece saying that landlords are now selling up properties, and they say that those sales are accounting for 1 in 6 of all property sales, which is up from 1 in 15 some 10 years ago. Now, again, this might be construed as landlords getting out of investments ahead of potential tax hikes coming from the new Labour government. This is the sort of stuff that might get the quid sitting up and taking notice if a lot of those landlords are foreigners who have invested in the UK. Nothing to do, there's no effect from UK landlords, but if there's foreign landlords coming in, which there are plenty, if they start taking money out, obviously we're going to see the pound reacting to that. So this is one of those little headlines, again, you just keep in the back of your mind when you're looking at the fiscal picture for the UK. Right, that's it on the old headline front. So what I'm going to do, should have a look at a couple of prices, and we'll have a look at talk about some stop losses and guide you through some of those. Where shall we start? Yeah, another funny thing. I think it was a Bloomberg piece put out, a headline Gav posted in our newsroom, and basically saying that the big pound rally has fizzled out. Market getting a wantsy over the quid, and the quid's in trouble. Well, they probably just picked the bottom in the market in that move, because it's done nothing but go up since they dropped that headline. So another nice move for Bloomberg there, and that story. Cable, it did, I said this yesterday, it did look like it was going to be going for a little bit of a crap out. But, you trade what you see, not what you think. And here we are now, moving up maybe towards 128 after that. So a pretty solid hold in the end down here. If it ain't going down, there's only one other way it can go. And so all of a sudden the quid is now back in favour for whatever reason. I didn't know why it was getting sold off so much. In the same vein, I don't know why it's bouncing back again either. But I don't care. If you don't know the reasons, just trade your levels. So the quid is back up. We've gone up through that small resistance area there. It's a bit of an on-off level. Where am I going? Around 127.40. So we've had, prior action there before. We had resistance there. We've gone above it, and we, give or take a couple of pips, we're holding it. So we're holding that break. We've gone above the fib, and now we're trying to hold it. So it's making these nice little steps up. It's playing nicely with the tech, and we're moving back up. But I still maintain it. Unless we start getting above 128, 128.50, this trend remains firmly entrenched. So not out the woods yet, but look at your levels. This is, again, going to solidify now as support. But if we get a quick move back down there, because we've seen these bounces and quick moves back down. So if we do get a quick move back down here, then maybe it's going to spell a bit of trouble for that level. Again, my thoughts, too many knocks on the door. But for now, it seems like a bit of pressure off. That pressure showing here in Euro Sterling as well, finally managing to push off from the 86 area. I took some profits into 70, further profits into 70 yesterday. Typically, I've gotten partial win at 85.50. Probably my fault for having it bang on the number 85.50. We got to, what did we get to? 49.7 on my platform. So I didn't get triggered on that exit. I may have to go to market because I, as I say, got a TP in against this level here. We have got these little levels in the way, 85.50, 85.30, which, if you take these little pips above and below it, you're probably looking at more 30.40 if we get through here. And then we're going to tackle the 85.20 zone. which was the traffic area on the way down before tackling the 85. So these are sort of levels I'll be looking to take further profits. If we get under 50, I'm probably going to start bringing my stop down just to start covering the rest of it. And that leads us into the discussion on stops. So you've got stop losses and you've got trailing stop losses. Okay. I don't know exactly what you want me to discuss about them, whoever you are, Zoom user, but what I'll tell you, the difference how I use them is pretty straightforward. When I enter a trade, I have a stop loss. Okay, that's a fixed risk amount. That's what I'm prepared to lose when I enter a trade. Trailing stop losses is what I use when I'm in a trade and I'm managing a trade. So the simple way to you can look at it is, say you're shorting euro sterling at 86 with a 30 pip stop loss. Okay, maybe you get 20 pips on the side. You take, for example, half the money off. Okay, so you've taken half your trade off. What you can do is you can then start moving your stop loss to cover the rest of the trade. Okay, so you start moving it back in. So now maybe you move it to a position where you've covered the other half. So if you get stopped out, you've given back only what you've made. Okay, so at the end of the day, if that happens, you haven't lost a penny except maybe commissions. So you've come out break even. The reason for trading stop losses, as I say, is not to make money, it's to reduce my risk. So the more the price keeps going down, the more I can reduce my risk. My stop on this trade is still at 86.30. Now, because of the slices I've made, even if I get hit on that stop, I'm going to make money purely because I've made enough on that side more than my stop will be on the other side. If we get in below 85.50, then I'm going to bring my stop down probably below my lowest entry. Okay, then I'm now booking in profit. So if I get stopped, I'm getting stopped in a profitable position. Not as much because I'll give some back, but I'm locking in that profit. The further a price moves in my way, the more I bring down my trailing stop, the more profits I lock in if I do finally get stopped. So what happens is the market will either keep going my way and I'll keep taking profits and I'll keep tightening my stops, or the market may move and it may go back and knock out my stops. I maybe may not make as much, but the important thing is I'm not losing anything either. And that's all I really do. It's just a, move as the price moves my way, I move my traders my way. But I use the levels to base how I move my trailing stops, okay? Because a lot of people, they get in a trade, okay? They trade off a level and then they ignore everything that's in the way. They trade up here at 86 and say, oh, I've short 86, I'm going to take profit at 84. Okay, well, what about all these levels that you got in your way? Okay, why would you pick a level to trade but ignore other levels that stand in your way? So I use those levels for taking profit. I also use those levels for my trading stops. If we get under 85.50, 85.30, okay, I'm going to take some profit. I'm probably going to move my stop down, probably just above that 85.50 level. Because if I'm respecting it on the way down, then I'm going to respect it with my stop. I don't want to put my stop on the level because we could come up and hit the level, trigger my stop, and then go down again. So what I do, as we always say, is you don't put your stops and TPs bang on levels, even though I've done just that today. But aside from that, so I would, if we get below 85.30, I'm going to bring my stop down probably below 85.70, above 85.50. Get back below this level, maybe 85s, I'm going to bring my stop down further, again, behind some of these levels that I'm looking at. So, as I say, first thing with trading stops is to get your risk to zero as soon as possible. That's my only concern with any trade. Okay, I don't think about profits. When I enter a trade, all I want to do is get to risk-free as quick as. After that, I'm in dreamland. The profits take care of itself. So sit down, sit back, put my feet up and see what the market wants to do and manage the trade as it goes. So you should always have a stop loss in place when you enter a trade. You should also think about trailing your stop when you're in a trade and it's going your way to protect your risk and to protect what you make thereafter. There's plenty of platforms. Oh, hi, Mark. Plenty of platforms have automated trailing stops. I don't tend to use them because you can use them, you know, things like MetaTrader, you can set in a trailing stop, so many pips behind the market. I don't tend to use them because there's times when I may manually adjust them. So if there's an event happening and I've got a trailing stop in, I may say, actually, you know what, there's a risk event in here. I've got a trailing stop, 85, 55, something's going to happen. I'm just going to knock it up above 80, another level, above 85, 70, just over whatever it is, data point or central bank speak or something, just in case there's a little bit of noise. I don't want to get knocked out in the noise and find the price goes my way. So I'm prepared to give back a little bit of profit, not increase my loss, give back a little bit of profit just to maybe stay out the noise. So I tend to go manually with my traders rather than leaving it to the machines. And but when you're in bed overnight, you've got no control over it. So it do whatever it wants to do. Yeah, exactly that, Mark. Yeah, some platforms have. If you want to go that route, there's nothing wrong with it. You know, particularly if, like I say, if you're not going to be at your desk for any period of time, you can leave your trading stop. The problem with that is if you can't leave in take profit points as well. So if you're in a position and it's not split up or whatever, you can't take a partial. So when you're doing those automated things, you may get down to a level you would have taken profit and your trader's already come down, but you haven't taken profit, then it's hit your lower trailer, if you get me. So I don't move my trailer until I've taken profit first on that particular part. Okay, so 85, 50, until I take profit, I'm not going to bring my stop down. Okay, so that's another reason why the automated thing doesn't work for me, because I only move my trailer after I've made the profit. But if you stick it automated, every time the price moves down, let's say it moves down 20 pips and your trailer comes down 10 pips, you may not take profit and then it may go and hit your trailer. So you haven't made that move, if you know what I'm getting at. Anyway, I hope that's answered your questions there, Mark. Anyone else got any questions or anything you want to hear about or want to know about to do with trading? Just throw them up. Happy to talk about them. In the meanwhile, we're going to have a look at what's going on some of the other pairs, assets. So dollar yen, it's trying to do this, trying to stay above this 147. 148 is obviously showing up, so maybe that's becoming more the level now than this 147. We've been up and down around it, trying to hold it, little dips under. Obviously, volatility is still pretty high in this, and it has pulled back. We're trading 13.13% in 1 month. Vols, we have been as high as 16, 17%, I think, this week. So vol is coming down a bit, but we're still at elevated levels. So we're still getting plenty of decent swings in this one, fairly rapid. So, but by and large, we're trying to build on this 147, but struggling to get through 148. So really, if you want to be you ballpark right now, if things remain calm, 146.50, bit of a pivot here, 147, 148, take your cues from that if you're trading it at all. Dollar CAD, what's going on in oil? Oil's still picking up a bit now. What are we trading? US oil up in the 76s. Let's have a look. I'm looking at there. So again, oil is holding up, and again, the CAD, particularly dollar CAD, is following what's going on in oil. So you can see we got up to here. Now we're doing a bit of sideways action. Again, all this Russia stuff, Ukraine stuff, Iran stuff is lending a little bit of a bid to what's going on here on the risk front. So bear that in mind if you're trading stuff that's related to these risk assets over the weekend. We're entering a weekend. You don't want to get hit by a headline. So if you're a bit nervy about that, maybe think about reducing those sort of risk positions. You can always get back in Sunday night, Monday if nothing's happened, but you've protected yourself over the weekend. So So with CAD, we've had a move down, and now it's going a bit sideways. Now, what you got to remember when you're trading correlations, okay, particularly something like oil in Canada, which throughout this period here, the last few months, there's been zero correlation between oil and CAD. Now we're seeing a bit of correlation coming in to this one. You've got to always remember it's not always going to go the same way. Okay, there will be a point if oil moves so far that CAD will run into its own fundamental levels where the market will go, you know what, CAD has strengthened too much compared to where the BOC is sitting or where the economy is sitting. And that's when you find your correlations start breaking down again. So it's not a linear thing that just because oil keeps going, CAD's going to keep going as well. We are bang in the middle here still, not much to do here. 137 is going to be a level as it has been on and off. Not really got my interest because it's a bit in the middle. I'll look at this 136.50, as I've said, down into the low 136. Good range trading at the moment, despite these little knockout moments. Shit happens, but by and large, it is respecting the range still. So I'm happy to play and have patience to wait either side of it. Michael saying, issue I deal with often, if I start with less than a full position, I still feel I should slice off profits at key levels. So I have trouble building a position. That depends on your strategy. If you want to build a position, okay, then you have to realize that you're going to, if you're going smaller, if you're not going a full position, you're building little bits, then you just have to realize that you may not make as much until you get the full position size on you want. There's still nothing wrong with slicing because you can always add back. Okay, you can slice a bit off, take a bit of profit, reduce your risk. But if it goes back to your level, you can always try again. You can always add back the bit you cut, keep your stop the same because you've already got some in the bank. So even if you did get stopped out on your original size position, you're still not going to lose as much because you took that first piece off. So when you're trying to get into a position, if you're not in a full position, the market goes your way, don't worry that you're not in the position you were. Just concentrate on playing the trade as if it was a full position. Don't think of the monetary side of things. Don't think, oh, I wanted to make $1,000 on that. If your position means you only make $500, well, so what? You've made $500. So you play your trade plan exactly the same, no matter what the position size is. I can do it if I'm building a long-term position. Let's say I want to start buying CAD at 136 because I think it's going to 142. Okay, so I might buy a little bit at 136. I'll have a plan to buy it there, 136.50, 136, 135, whatever. I may not get all my entries in. I may only get 1 or 2 entries in, and then perhaps the trade goes my way. So I haven't got as big a position as I planned to do if all my levels were hit, but I don't care. Okay, I'm in the position. I'm going to manage the position the same way I would every other position. I don't care if I don't make as much money because I haven't got a bigger position on. I'm happy to make money, whether it's big, small, or whatever. I want to be right, not wrong. So it's one of these psychological things that people think I have to make that amount of money on the trade. Don't. Get the trade right. Okay, your profits and the monetary value will come along it. Get your trade right first. Worry about the pounds and pence of the trade afterwards. Mark, yeah, I trade level. I don't, me, I don't like patterns, that many patterns, head and shoulders, all that cobblers. Not for me. Things like head and shoulders, and I've explained it before. People look at head and shoulders. You can trade a head and shoulders pattern, okay, well before it even starts. Okay, let's look at this one. Okay, you could say this has got a bit of head and shoulders to it. Let me see if I can do some drawing. I'm not good with the old drawings like some of the others. So let's see. Let's take that off. So you could say maybe, call it a cock formation. There we go. You could say there may have been a head and shoulders thing setting up there. Okay, I'm not looking to wait for that and see where the epoxy neckline is and wait for that move or whatever. Okay, I don't need to worry about that. Here's what I'm looking at. Here's a level. We hit the level. We broke the level. We come down. Do we hold the level again? If we hold the level again, that's the trade. Okay, the trade is here. It's not here. It's here. That's the trade entry, because that's telling you, based on this line here, it's resistance, it broke, we came back under, we held it. That is what indicates you get this sort of move. So the fact that people put these patterns on after it's confirmed, after it looks like the pattern, okay, there's no interest to me in trading. I want to know this point. I want to know if this happens. We hold the level, we break the level, do we hold the level again? So those are the patterns I look for in trades. Okay. So I do look at patterns, but I look at support and resistance patterns. You know, that's why I put lines in here, because we hit a level, can't get to a level, hit the level, hit the level, hit the level, break the level, hold the level. That's the only pattern I need. Okay. And I've explained it earlier this week. Yesterday, was it yesterday I spoke about it? You know, how many lines do you need on a chart? You know, this is patterns. This is my patterns. Finding places where the price always tends to do something. Okay, where it always tends to. These are my patterns. I don't care if there's a frigging head and shoulders or a fucking bat wing or crab or dinosaur or whatever crap is in there. I don't care about all that. All I'm interested in is where the price is going to do something. Now, it may sound like I'm slagging off people who use that stuff. I'm not. I just don't use it. People who do use it, good luck to them. If people can make money off of that sort of stuff, I'm absolutely over the moon. And there's plenty of people to do that. You know, Ben in our room, he loves a zoo, as I like to call it. He loves his zoo animals, crabs, bats, whatever. If he makes money off of that, then all the power to him. That's brilliant. I'm chuffed to bits, but not for me. It's just my way. Everyone trades their own way. Everyone finds their own way. Each to their own. Exactly, Michael. So if you're happy doing it, trading it, whatever, you be my guest and go ahead. For me, it's witchcraft. That's it. End of. Right. Anything else for anything else? Or I'm going to call it a session for this week. And yeah, K-Man's off, I think, for half of next week. So boys and girls, I'm going to stick you some homework for the weekend. You know, come up with some questions like Mark has, asking about stops and whatnot and patterns and everything. And, you know, give me something to talk about next week and we'll get into it. All right, go on then. Sudan, let's have a look at dollar Swiss quickly before we clear off. No real change to my thought here. 85.50, as I said, that's been the important level. Again, you want your pattern, hold, break, hold, break, hold. Okay, so that's the level down below. For me, we've got a bit of noise in here, but nothing's going to happen until we get up to the 87 and a half, and then we see what we do from there. Back under 85 and a half, we're potentially heading back towards that low there in the 84s, maybe even a move to down there. If we get back under there, keep an eye out for our good old mates at the SMB. Right, that's it. Enough. Boys and girls, have a wonderful weekend. Thank you for joining us here at the Flow Show. If you're in our chat room, and if you're not, you can join us on Face a bit later. Have a wonderful weekend, a peaceful, safe weekend. We'll see you next week.